Welcome back to the Pro Ticker Podcast. It's Wednesday morning, and we're covering major financial magazine headlines. So everyone, today we're diving into, wow, some pretty fascinating stories, I got to say.
Oh, yeah.
Really caught my eye this time.
Yeah.
And, it seems like they're all connected somehow. Everything from the struggles of, actively managed funds,
Yeah.
all the way to, like, these mind-boggling valuations we're seeing. For some of these AI startups, there's just a lot to unpack here, so let's get started.
Yeah, you're absolutely right. Definitely some strong undercurrents driving a lot of these seemingly separate stories. We're seeing shifts in market dynamics,
Right.
investor sentiment, and even how technology is changing the economy as a whole.
Okay, so let's start with this Market Watch headline about active mutual funds
Wow.
having a tough time beating those large cap benchmarks again. It says only 36% of actively managed U.S. large cap mutual funds outperformed the Russell 1000 benchmark in 2024. That's the lowest success rate since 2020. So what's going on here? Why are active managers having such a hard time?
Well, it's a question that keeps coming up. And it's not just about bad luck or even skill. There are some fundamental forces at work here MarketWatch points to. The growing influence of these magnificent seven tech companies,
Hmm.
Apple, NVIDIA, Microsoft, Amazon, Meta, Google, and Tesla. I mean, they make up such a big chunk of the Russell 1000 that it's hard for active managers to make choices that, really differentiate their performance.
So if you're listening to this and you're invested in mutual funds,
Mhm.
especially those with higher fees for active management, I mean, this is important stuff. You're paying extra for some of the big stocks. But are they actually getting you better returns than just tracking the market?
That's the million-dollar question, isn't it? And while 2024 was tough for active managers, that 36% success rate is actually pretty typical. It's been about the same since 2003, which makes you wonder if this is just how the market works now.
Okay, so let's talk more about these Magnificent Seven. It seems like they're everywhere. MarketWatch had another piece about how they heavily influenced the Russell 1000's performance in 2024. They were some of the top holdings in the iShares Russell 1000 ETF, according to BlackRock's data. So is all this concentration a good thing? Or could be a problem down the road?
Well, that's a debate that's going on right now. On one hand, these companies are driving innovation and creating jobs. They're pushing the economy forward. But on the other hand, when so much power is concentrated in just a few companies, it can stifle competition. Plus, if one of them stumbles, it could have a ripple effect across the entire market.
And get this, their bonds are even getting attention. MarketWatch is calling the Magnificent Seven bonds. They've been selling off lately, and that's pushed yields higher. Some analysts are even wondering if this might be a good buying opportunity. What do you think?
That's a really interesting point. This recent rise in bond yields is tied to what's happening with Treasury yields, which are reflecting concerns about inflation and where the economy is headed. So are these Magnificent Seven bonds a good deal? Well, that depends on how you see the big picture playing out.
So it's all connected, right? These seemingly separate stories about active funds, mega cap companies, and even bond yields. They're all intertwined.
Exactly. It's like a web. And understanding those connections can help you make better sense of the financial world.
Now, still focusing on large cap companies, MarketWatch highlighted an interesting trend. While active growth funds had a tough time, large cap value funds mostly did better than their benchmarks in 2024. So what's driving that difference?
Well, it comes down to investment styles and how they perform in different market conditions. Value stocks, those are companies with solid fundamentals, but maybe slower growth. They did well last year when interest rates were climbing, and there were worries about a potential economic slowdown. So the choice between growth and value really depends on your risk tolerance and how you see the market playing out.
All right, now let's get to the really exciting part, the AI gold rush. There was a piece in the Wall Street Journal about Anthropic, an AI startup that's raising funds at a $60 billion valuation. That's insane.
That's a valuation that puts them ahead of many established companies. It shows just how much potential investors see in AI, even though, many of these startups aren't profitable yet.
But what's so special about Anthropic? There are tons of AI companies out there.
One of their big selling points is their focus on AI safety testing. It's a field where things are moving really fast. And there are real risks if the technology is misused. Anthropic's commitment to developing AI responsibly really sets them apart.
That makes sense.
Yeah.
But let's not forget the giants in the room, Amazon and Microsoft. The Wall Street Journal pointed out how this AI boom, with its massive need for computing power, is a huge win for cloud providers, like Amazon Web Services, or AWS, and Microsoft Azure,
Absolutely. While the AI startups are grabbing headlines, the companies providing the infrastructure for all this development are quietly making a lot of money.
Which brings up a really important question. Can these AI startups actually become profitable? Or are they just enriching their investors?
And here's a detail I found fascinating. Both OpenAI, which is backed by Microsoft, and Anthropic, backed by Amazon, are reportedly losing money, even with those huge valuations.
Yeah, it shows how speculative this whole AI investment landscape is right now. Investors are betting on the long-term potential of these companies to reshape industries
Yeah.
and even create new markets, you know? It's a bit like the dot-com bubble, where valuations were based on future promises rather than current earnings. Speaking of the global landscape,
Mhm.
Bloomberg had some data on European markets. It looks like Eurozone inflation rose to 2.4% in December. How does that impact things over here?
Well, global inflation trends always have an impact. Rising prices in Europe can affect supply chains and currency exchange rates worldwide. And with the possibility of U.S. tariffs on the horizon, understanding how global inflation and trade policies interact is crucial for investors.
You know, this whole AI boom is making me think, if these startups go public at their current valuations, could we see a tech bubble? Even bigger than the dot-com era. I mean, $60 billion for a company that's still losing money. Seems like a lot of faith in the future.
Yeah, it's a valid concern. We've seen this pattern before, where investor enthusiasm gets ahead of the fundamentals. But we also have to remember that. AI is a truly transformative technology with the potential to revolutionize many industries.
It's like a high-stakes poker game, right? Will these AI companies become the next Apple or Google? Or will their valuations come crashing down? Only time will tell.
Only time will tell, that's for sure. And the impact on cloud computing, that's just one piece of the puzzle. Think about it. Healthcare, transportation, finance. AI is going to touch virtually every sector of the economy in some way.
Yeah, it's like
Yeah.
we're watching this giant wave build momentum. And those first ripples are just starting to hit the shore. So what other companies are making waves in the AI space besides Anthropic?
Well, NVIDIA is definitely one to watch. They make the chips that power a lot of this AI development. But MarketWatch reported that their stock had its worst drop in months, even after CEO Jensen Huang gave a keynote address at CES.
Oh, so what happened? Was it a buy the rumor, sell the news kind of situation?
That seems to be the case. The stock had been climbing in the days leading up to Huang's speech, maybe because investors were expecting some big announcements. But the speech didn't live up to the hype.
So what were people hoping for?
Well, while NVIDIA did announce some interesting things, like a personal supercomputer running a new Blackwell chip, and a partnership for driverless truck technology, it seems investors were really waiting for concrete updates on their next-generation chip platform, codenamed Rubin.
Sounds like the pressure is on for these companies to keep innovating and stay ahead of the curve. Speaking of pressure, Tesla had some news this week, and it wasn't all good. Bank of America downgraded their stock to neutral from buy. Why is that?
Well, Bank of America argued that while Tesla's stock price reflects, the long-term potential of things, like robotaxis and energy storage, it doesn't fully account for the risk that they might not be able to execute those plans successfully.
So they're saying Tesla might be a bit overhyped right now.
Not necessarily. They're actually quite bullish on Tesla's robotaxi prospects. In fact, they estimate that robotaxis account for about half of Tesla's current valuation. But Tesla faces stiff competition in electric vehicles and autonomous driving, and expanding into new areas, like robotaxis and energy storage, comes with big challenges in scaling production and becoming profitable.
Yeah, it sounds like another example of investors betting on future potential,
Yeah.
even when the path to profitability is uncertain, like what we were talking about with the AI bubble.
Exactly. And we've seen this play out before, most notably with the dot-com bubble. Investors get swept up in the excitement of a new technology, and valuations become disconnected from reality.
So what's the takeaway for our listeners?
It's about being cautious and realistic. The AI revolution and the move toward electric vehicles. They're exciting and potentially transformative, but don't get blinded by the hype. Do your research, understand the risks, and make sure your investments match your long-term financial goals.
Solid advice. Now, I want to go back to something you said earlier about the bond market. You mentioned the bond market timers are actually pretty bearish right now, which could be a contrarian signal. Can you explain that a bit more?
Sure. Mark Holbert wrote a really interesting article on MarketWatch about this. He pointed out that market timers, those who try to predict short-term market movements, they're often wrong at major turning points. So their current pessimism could actually be a sign that the market is about to turn upward.
So be fearful when others are greedy. And greedy when others are fearful, right?
Exactly. Holbert's analysis shows that. The sentiment index for bond market timers is at a historically low level, suggesting that investors are overly pessimistic about bonds, so this could present an opportunity for those willing to go against the crowd.
Interesting. So while everyone's focused on the AI, gold rush, and Tesla, there might be some value hiding in the often overlooked bond market.
It's definitely worth considering. Bonds can add diversification and stability to a portfolio, especially during times of market uncertainty.
And speaking of diversification, we haven't talked much about real estate today. Barron's had an article saying that home prices are still high, but it's getting easier to buy in some places. So is there some good news on the housing front?
There is. While the national housing market remains expensive, certain areas, particularly in Texas, are becoming more affordable.
So it's not all doom and gloom for potential home buyers.
Not at all. Real estate always has pockets of opportunity. It just takes research and an understanding of local market dynamics.
Yeah, this deep dive has covered a lot. AI, mega caps, those market timers, even a bit about real estate. It's been a whirlwind.
That's the financial market for you. Always something new to learn and analyze. That's part of what makes it so fascinating.
Absolutely. Bloomberg had one more headline that caught my eye. Singapore's stock benchmark hit a record high as banks rallied. It seems like a surprise, given all the talk about U.S. markets struggling.
It highlights how global markets can move in unexpected ways, while the U.S. grapples with inflation and potential slowdown. Singapore's market is being driven by strong performance in its banking sector.
So there's always a bull market somewhere.
Precisely.
Now let's talk about something that's been causing a lot of uncertainty in the markets lately. The return of Donald Trump to the White House. MarketWatch had an article about how investors should watch the dollar as markets try to understand Trump's tariff plans.
Yeah, Trump's trade policies have always been a source of market volatility, and his second term is likely to be no different. The article mentioned that the dollar initially weakened when there were reports that Trump might consider narrower tariffs, but it quickly rebounded when he denied those reports.
So the market is still trying to figure out what to make of Trump's trade agenda. What do you make of it?
Well, it's hard to say for sure, and the uncertainty is likely to continue. The article pointed out that, Trump probably won't roll out all his tariff plans at once. He'll likely use a mix of executive orders and legislation, which will create a series of announcements and deadlines throughout the year.
Sounds like we're in for a bumpy ride.
Indeed. But remember, volatility can also create opportunities for investors. It's a good reminder. That finance is a global game. What happens in one part of the world can have ripple effects everywhere else.
Right, and that makes diversification even more important, right?
Yeah.
You need a portfolio that can handle,
Yeah.
those global ups and downs.
Absolutely. A well-diversified portfolio is key to navigating, the complexities of the global market.
Okay, so we've covered a lot today.
Yeah.
AI, mega caps, those market timers, even a bit about real estate, and of course, the return of Trump and those tariffs. It's enough to make your head spin.
That's the nature of financial markets. Always something new to learn, something to analyze, but that's also what makes it so fascinating.
Absolutely. Well, before we wrap up, I want to leave our listeners with something to think about. We've talked about all these big forces shaping the financial landscape. But what about the human element? Where do people fit into this rapidly changing world?
Yeah, that's a question we all need to grapple with. Technology is advancing so quickly. It's changing how we live, how we work, and how we interact with the world. The key is to find ways to harness the power of technology without losing sight of our humanity.
Yeah, I think that's a great point to end on. This deep dive has been a fascinating journey through the world of finance, hopefully. Our listeners have a better understanding of the trends and forces shaping the markets.
And maybe some food for thought as they make their own financial decisions.
Well said. We'll see you all tomorrow morning with new headlines from major financial magazines.